Poonawalla FinCorp also reported a good set of Q3 numbers, and the stock currently reacting positively to that. Their assets under management grew 56%. To discuss more on this, we have Abhay Bhutada, the Managing Director of Poonawalla FinCorp. Abhay, thanks for joining in. Can you start by telling us what was your incremental cost of funds this quarter compared to the average cost of funds?
See, our incremental cost of fund is 8%, and our average cost of borrowing for the quarter was 7.99%. So almost flat on a quarter-on-quarter basis, despite of RBI tightening the policy, despite of 225 bips increase in the interest rates and market condition, there is no impact on the overall cost of fund because of a proper mix of CP, NCD and the bank borrowing. We are a CRISIL AAA rated NBFC, so that's why we are able to maintain the cost of fund at sub-8 levels.
So do you see the cost of funds going down from these levels?
So for 1 or 2 quarters, maybe liquidity will be tight in the market. So we don't see a major impact. But we have a lot of short-term lending, almost 20-25%. So we are focusing more on the CP, which we get at a lesser level, though right now that is also again getting at a higher rate. But yes, 1 or 2 quarters down the line, subject to RBI policy, you may expect reduction in the overall cost of funds.
Right. Your net interest margins this quarter was up year on year, but it was down on a quarter-on-quarter basis. What would you attribute that to? And what's the outlook on this margin going forward?
See, if you see, we have always guided about 10% NIM over a last period of 2 years. Because of a lot of short-term product in nature, we get good amount of profitability over there. And considering the current cost of fund RBI rate increase, I think we have clearly guided that we will be able to maintain and confident to achieve about 10 level on a long-term and steady-state basis. And lot of legacy rundown, legacy our old Magma loan book, legacy rundown and legacy write-off, it gets adjusted as per the accounting standard into the ECL. It is not getting added into the revenue. So as such, on a sequential basis also, there is no, in actual sense, there is no reduction in the NIM. However, still on a long-term steady on state basis, we will be able to maintain about 10%.
Your disbursals are up 11% on a sequential basis. Do you expect this kind of loan growth to continue? And also, just one more word, the RBI has raised the caution on unsecured lending. What's your view on the same?
See, basically, if you see, my current leverage is 1.5 and capital adequacy is 38%. So we don't see any major impact in terms of growth. But at the same time, we want to stick to our guidance of 35 to 40%. We are able to maintain secured unsecured ratio of 50%. This quarter secured is 52, unsecured is 48%. We don't lend to new to credit customer. We lend to where there is a cash flow, bureau tested customer, there is a business vintage and credit tested customer. So practically, if you see the segment which we are operating, you cannot give same treatment or anyone cannot give same treatment to all. We have a learning from our past in terms of all the unsecured product. There was a NBFC Poonawalla Finance of the same group, wherein we used to do personal loan, professional loan, business loan. So we have learned 2 to 3 years over there, all the unsecured products. And with this, our learning, strong risk culture, what we build in the organization, strong risk management, strong analytics team, I think we don't see any challenge. If you see our new book is performing well, better than our expectation. So if you see the GNP also out of 1.33%, our GNP is only 0.42% in the new book. And NP, net NP is only 0.23 on the new book out of 0.70. So we don't expect there also, whatever guidance we are given, net NPA will be below 1 as per stated management vision 2025. So coming back to your question, we don't see any impact of this RBI circular. In fact, we are getting advantage because of this lot of players, they are not able to give raise the funds. The cost of fund is high. So on the fintech side, on the NBFC side, those who are leverage of above 4 and 5, they are struggling. Our leverage is 1.5. So I think we are getting advantage. In fact, there is an opportunity and we lend only above 50,000 ticket size. The major impact is for a smaller ticket size, those who are lending below 50,000. So if you see overall, there is no impact on the Poonawalla FinCorp.
All right, you mentioned that liquidity will remain tight over the next 1 to 2 quarters. How do you see that changing your liability profile, if there's going to be any change at all?
See, right now, there is no impact because if you see last quarter versus this quarter, hardly there is impact on the cost of fund. So because of our less leverage, we sold our housing to TPG. Last quarter, we got post-tax 3,000 crore rupees. So now we are sitting with the excess capital. Capital adequacy is also 38%. Even if we grow at 35 to 40%, we will not require any additional capital over a period of next 3 to 4 years. So we don't see any major impact. And we have a diversified term loan, WCDL. We have a commercial paper, NCD. So we have well diversified NBFC in terms of liability profile as well.
What is the outlook on credit costs for the remainder of this year and more importantly for FY25?
So credit cost, we have given guidance of in the range of 0.8 to 1.2% on a long-term basis. On the GNPA side, we will be able to maintain below 1.5. Net NPA will be able to maintain below 1%. And if you see the current GNPA and NPA number include the legacy book, if you exclude that, the numbers are on a much lower side. But yes, whatever stated vision management 2025 we have given, we will be always able to maintain net NPA below 1.
Thank you very much for joining in. That's Poonawalla FinCorp for you.